As you will recall, future receivables such as mortgage payments, credit card payments, utility bill payments, in fact all future receivables lend themselves to securitization, more so if they are backed by assets such as a home or an automobile. In this and the next session, we will focus on the most common types of securitization: residential mortgage-backed securities, or RMBS for short, and credit card securitization. We will look at RMBS in this session and credit card securitization in the next session. Residential mortgage-backed securities are backed by a large number of home mortgages assembled into a mortgage pool. Special purpose vehicles, or SPVs, which are called trustees in the context of RMBS, serve as custodians of the mortgage pool held as a collateral for the RMBS transaction. Most RMBS transactions adopt the pass-through certificate structure that we saw in an earlier session to transfer cash flows from the borrowers to the investors. As we already saw, in a pass-through certificate, the originator will realize the repayment of the loan installment from the borrowers and immediately forward it to the SPV, who in turn will transfer the same immediately to the investors in proportion to their holdings. Governments in several countries around the world encourage their citizens to take mortgage loans, which are in turn securitized in the financial markets. Government agencies such as, for instance, Fannie Mae in the United States act as market makers by underwriting the securitization tranches. This ecosystem enables and encourages home ownership and the creation of long-term assets by the citizens of the country, which in turn facilitates economic activity and consequent long-term growth and stability in the economy. Insurance companies and pension funds and other entities that enjoy long-term liabilities on their balance sheet invest actively in RMBS transactions, both for long-term holding and for short-term buying and selling, that is trading. In the United States, for instance, the securitization markets for RMBS is extremely liquid and records trading, that is buying and selling, of tens of millions of dollars every day. Now, what are the risks in investing in residential mortgage-backed securities? Like all securities traded in the financial markets, RMBS also carries default risk and interest rate risk. Default risk refers to the original borrower's failure to meet his repayment obligations. As already discussed in an earlier video, default risk is mitigated in a number of ways, including the following: cash collaterals provided by the mortgage institution, that means the originator of the loans. B, a subordinated structure where the junior class investors provide protection to the next senior class and hence returns are top down, that means senior most gets the lowest return. C, traditional insurance against default risk provided by insurance companies or guarantees provided by the banks. And 4, credit derivatives such as credit default swaps, or CDS for short, very commonly used, the details of which we will see in a later session. Now, let's look at interest rate risks associated with an RMBS transaction. RMBS transactions carry interest rate risks in much the same way as corporate bonds. That means if the interest rates in the economy go down, the price of the RMBS paper goes up and vice versa. In addition, a unique and perhaps a more important form of interest rate risk in the context of RMBS pertains to pre-closure or prepayment of the loan. Let's look at why prepayment risks arise in RMBS and how they are managed. Mortgages are prepaid for reasons such as fall in interest rates. So the borrower will want to reprice the loan at the lower interest rate. Or, for example, homeowners relocating to another city. So he closes this mortgage and takes a new mortgage loan in his new city of residence. Prepayment of mortgages result in, from an investor's perspective, accelerated cash inflows and consequent reduction in the future interest income. To protect themselves against loss of income arising from prepayment of loans, which is referred to as prepayment risk, returns on RMBS is computed taking into consideration the scheduled repayment, the projected default rate, as well as the projected prepayment rate, and the monthly mortgage payments are adjusted accordingly. Prepayment rates are arrived at based on historical data on prepayments referred to as conditional prepayment rate, or CPR for short. In the United Kingdom, for example, based on data over the last 37 years, the CPR varies from 9.5% to 14% about 85% of the time, and that is statistically significant. Incidentally, CPR has historically been found to be higher when the mortgage is seasoned. That means when the loan has run a few years, and very much lower when the loans are new. That means not yet seasoned. CPR is an annual rate which is then converted into a single monthly mortality rate, or SMM, and this SMM is then used to adjust the monthly mortgage payments. In other words, marginally increase the monthly mortgage payment as a protection or a hedge against prepayment risk. That brings us to the end of our discussion on residential mortgage-backed securities. In the next session, we will look at credit card securitization.